I'm Gloria Ledoux here on the CU Compliance Connection by League Info site, bringing you the Compliance Outlook for a review of compliance effective dates for regulations that may be impacting your credit union in the fourth quarter of 2018 and the first quarter of 2019. During the fourth quarter, credit unions who were conducting mortgage lending were probably focusing on the changes made to the TILA-RESPA Integrated Mortgage Disclosures, or TRIG 2.0, as the industry has nicknamed it. TRIG 2.0 incorporated informal guidance that the BCFP, or Bureau of Consumer Financial Protection, had provided on various issues and also made some additional clarifications and technical amendments. Now, for the first quarter of 2019, credit unions will again have to make sure their policies and procedures are updated with all of the annual updates, most of which result from changes in the Consumer Price Index. We also have some changes that impact the shift of liability under Regulation CC, and we're going to briefly cover that. And finally, for some regulatory relief, we wanted to draw attention to the delay of the NCUA's risk-based capital rule that was scheduled to become effective on January 1st, 2019. Credit unions now have another year to ensure compliance. Some additional relief also came through that supplemental final rule, which raised the asset threshold for a complex credit union from $100 million to $500 million, which should exempt even more credit unions. As previously mentioned, the updates to the Integrated Mortgage Disclosures, or TRIG 2.0, addressed a lot of technical corrections and clarifications. However, we wanted to address a few of the changes that we believe will impact credit unions the most. Please note that this is not an exhaustive list of the changes. One thing that TRIG 2.0 did was to solidify the coverage of cooperative units. Prior to this change, there was different interpretations based on state law, depending on whether the cooperative unit was considered personal or real property. Now, under the rules, it doesn't matter. As long as it's a closed-end consumer transaction, it will be covered by the TRIG rules, and credit unions will be required to provide the corresponding disclosures. The new rule allows the credit union to voluntarily extend the expiration date of a loan estimate, either orally or in writing, if they choose to provide the consumer a longer period to indicate an intent to proceed. Now, moving to the closing disclosure changes, there is an amendment related to the disclosure of the total of payments. Now, there is a new tolerance requirement that mirrors the tolerances that are currently in effect and applicable for finance charges. Payments will be considered accurate if the amount disclosed for a non-rescindable transaction is overstated or understated by no more than $100. For a rescindable transaction, overstated or understated by no more than half of 1% of the loan amount or $100, whichever is greater. Moving along, another amendment related to the closing disclosure clarifies and now illustrates what a revised version of a closing disclosure can look like if, for example, the credit union needs to share the disclosures with various third parties involved in the mortgage origination process, for example, a seller. The revised disclosure extracts certain data that is not relevant and in some states may actually be a breach of law. Generally speaking, most of the changes made to TRIG 2.0 will apply to applications that were received on or after October 1st of 2018. However, the rules clarified and differentiated the requirements for the escrow closing notice and partial payment disclosure requirements. The rule clarified that these requirements are applicable on and after October 1st, 2018, regardless when the application was received. Since the escrow closing notice and the partial payment disclosures are post-consummation notices, there was some confusion on applicability. This amendment sought to clarify. Therefore, if an escrow account is canceled after October 1st, 2018, the credit union must provide the applicable notice no matter when the application for the loan was actually received. This is the same concept for the partial payment disclosure. If the credit union purchases a mortgage loan, they must provide that notice related to the partial payment policy that will apply to the loan, if applicable, after that October 1st, 2018 date, regardless of when the application was received. There were also numerous amendments and clarifications related to construction loans. We'll cover a few of them here. The credit union has the choice of disclosing construction to permanent loans as either two separate transactions or one single transaction. If the credit union is disclosing a construction to permanent loan as two separate transactions, they will need to provide a loan estimate for each phase within 3 business days of receiving an application for that applicable phase. In addition, the credit union must allocate to the construction phase amounts for finance charges and points and fees that would not be imposed except for the construction financing. Other amounts for finance charges and points and fees should be allocated to the permanent phase. Any additional fees that are not finance charges or points and fees may be allocated between the construction phase and permanent phase in any manner the credit union decides. Now, if the credit union discloses the construction to permanent loan as a single transaction, the loan term should be the combined term for both phases. For example, a construction phase of 12 months and a permanent phase of 30 years should be disclosed with a term of 31 years. The rule also addresses and clarifies quite a few different situations related to construction loans, such as interest rate disclosures when a certain interest rate is unknown, mortgage insurance and escrow payments when only the permanent phase requires that, and it's disclosed as a single transaction, and projected payment table completion. This particular amendment is designed to fix the industry-coined black hole related to TRIG and to provide credit unions with more flexibility when there are changes after the closing disclosure has been provided to the borrower, but prior to consummation. Prior to this amendment, TRIG did not allow credit unions to use a closing disclosure to reflect revised costs if there were more than 4 business days between the time the revised disclosures are required to be provided and consummation. This resulted in situations where the credit union ended up covering a higher fee as opposed to the borrower being required to pay the fee. Now, as an example, and as clarified in the amended regulation, if consummation is scheduled for Thursday, June 4th, and the credit union hand delivers the closing disclosure on Monday, June 1st, then on Tuesday, June 2nd, the borrower requests a change to the loan that would result in revised disclosures but not warrant a new waiting period, the credit union is required to provide corrected disclosures reflecting any changed terms to the borrower so that they receive a corrected disclosure at or before consummation. The credit union can comply with this by hand delivering the revised closing disclosure reflecting the change now on Thursday, June 4th. The last thing we wanted to cover under TRIG 2.0 refers to settlement services and providers. The amendments clarify that if a credit union fails to disclose a specific settlement service on the written list of providers or fails to provide the list entirely, the 10% aggregate standard for determining good faith continues to apply to a required third-party, non-affiliated settlement service charge that otherwise complies with the regulation. All right, let's move and dive into 2019 with our annual threshold changes. Remember, as we discuss every year, credit unions should make sure that their respective policies, procedures, and lending platforms or systems are up to date with these new thresholds that become effective on January 1st of every year. The Home Ownership and Equity Protection Act, or HOEPA, governs high-cost mortgage requirements. If the credit union is originating a mortgage that is considered high cost, there are specific disclosure requirements, certain restrictions on transaction terms, fees, and practices, specific ability to repay requirements, and home ownership counseling obligations. Therefore, it is critical for the credit union to identify if a mortgage loan will be considered high cost. As with many of the BCFP's regulations, certain thresholds adjust each year in accordance with the Consumer Price Index for all urban consumers. For HOEPA, the BCFP adjusted the points and fees thresholds to determine if a loan is considered high cost. So any of the credit union's loans with points and fees exceeding these thresholds will be considered high cost and are subject to the additional restrictions. There are certain escrow requirements for loans that are considered higher priced. Remember that higher price mortgage loans differ from higher cost mortgage loans, which we just discussed. A mortgage loan is considered higher priced if it is a first lien mortgage other than a jumbo loan that has an APR that exceeds the average prime offer rate or APOR, by 1.5 percentage points or more. For first lien jumbo loans, the loan would be higher priced if it had an APR that exceeded the APOR by more than 2.5 percentage points. For subordinate lien loans to be considered higher priced, there needs to be an APR that exceeds the APOR by 3.5 percentage points or more. The credit union is typically required to escrow for higher priced mortgage loans. However, some credit unions may be eligible for an exemption based on their asset size, amongst a few other criteria, which is listed on the slide. Each year, the BCFP adjusts this asset threshold, which, as of the time of this recording, has not yet been published. As a reminder, credit unions must maintain and establish escrow accounts for first lien, higher priced mortgage loans for at least 5 years. The requirement does not apply to subordinate liens or HELOCs. However, if you have a fixed home equity in first position, the escrow requirements will apply if the loan is considered to be a high-priced mortgage loan. There are certain appraisal requirements for loans that are considered higher priced, which we have listed in the slide. However, loans that are less than $26,700, which is an amount that is indexed for inflation each year, are actually exempt from the requirements under the rule. For a loan to be considered a qualified mortgage and receive the safe harbor protections, the loan's points and fees must not exceed certain thresholds. These thresholds typically increase each year. These are the new thresholds for 2019. Again, if credit unions are relying on their lending systems to acknowledge if a loan is considered a higher cost or qualified under the rules, it's very important to make sure that these thresholds are updated. Credit unions should be aware of the safe harbor penalty fee limits for credit cards, which are $28 for the first late fee payment and $39 for each subsequent violation within the following 6 months. Credit unions should double check to make sure they are not charging more than these amounts. The credit union will be required to collect and report data under the Home Mortgage Disclosure Act, or HMDA, if it is considered a financial institution under the rule. Now remember, the credit union is only subject to HMDA if it meets all of the following criteria listed in the slide, which is what the definition of a financial institution is. The asset size threshold for determining whether a credit union meets the definition of a financial institution is adjusted every year. For 2019, the threshold has not yet been published as of the date of this recording. For 2018, the asset size was $45 million. As part of Regulation D, credit unions are required to maintain certain reserves based on the mix of deposits at the credit union. The threshold amounts for those reserve requirements adjust each year and are listed here for 2019. The IRS changes the Health Savings Account, or HSA, contribution limits each year. For 2019, the limit for an individual plan is $3,500, and the limit for a family plan is $7,000. Last but not least, rounding out the changes become effective in the first quarter of 2019 are some changes made to Regulation CC and the corresponding liability when disputes between banks, which includes credit unions in the definition, arises as to whether a substitute or electronic check contains an alteration or is derived from an original check that was issued with an authorized signature of the drawer. The changes provide a rebuttable presumption that the substitute check or electronic check contains an alteration when there is no original check available for inspection. If the original check is made available for inspection, the presumption does not apply. Credit unions should keep in mind that this presumption applies only to disputes between banks and only when one bank transferred an electronic or substitute check to the other bank. Even when we think things are slowing down, there still seems to be an impressive amount of changes for credit unions to consider and implement. Don't forget about the other League InfoSite products available through your league or association, such as InfoSite, CU Policy Pro, and ComplySite, which are additional resources to assist you with compliance. Please make sure to take advantage of them. If you don't know how to access those resources or want to learn more, please reach out to your league or association or visit our website. As always, thank you so much for joining us at the CU Compliance Connection by League InfoSite.